Money, 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 money. Money, 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 money. Money. Hey, listen. Obviously, I know you want to learn how to build wealth. Same here. So we're going to react to this content. Shout out to everyone involved with Savvy Wallet Podcast. Get me? It's only right that I react to this content. Get me? So if you're into finance and things like of that nature and wealth building and wealth maintenance and investment and things of that nature, hit the subscribe button, turn on your post notification. You know what I mean? Because more content like that is coming. It's on the way. But yeah, man, let's keep it moving. All right. So, whoa, 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 hold on. Sorry about the technical difficulties, but yeah, look, give me a second. I want to make sure I'm set up properly. All right, so yeah, let's get into it. Wealth Advisor reveals their number one way to build wealth in the stock market on any budget. On any budget. It is how you build wealth on any budget. Let's go then. Get me? I mean, as we wait, we can still sing money, 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 money.
Stop drawing trend lines, support and resistance lines off the chart, convincing yourself that you're getting better at trading. For most traders,
one thing that I have learned over the many years of doing it.
Wait. We're going to rewind that from the very, very beginning because that was 30 seconds of, you know what I'm saying? Wait. YouTube have changed their system. All right, there you go.
Sometimes it's not very easy when you are a professional in the money management space and you hear certain things and you're like, I disagree with that. I don't think that's right. And one of those things is, for example, everybody should invest in an index fund or an S&P 500 being the obvious one.
You're going to trigger people.
I'm going to trigger some people.
According to several studies, more than 70% of retail investors end up losing money. Why do so many people struggle to make money in the stock market?
It's not that people don't make money. It's that people make money, but they also lose money and they lose more money than they make. It's because people don't invest according to their own mandates. The one thing that I have learned over the many years of doing it professionally and as a retail investor myself is that the best investment that anybody can make is one that they can stick with.
A lot of retail investors.
That's interesting. Because you often hear about diversify. But let's continue and hear what he's gonna say, because this is gonna be interesting. Hit the subscribe button, turn in the post notification. Let's keep it moving. Get me? If you're interested in finance, trust me, dog. We are going to react to more content regarding finance. Yeah, on so many different levels, so many different currencies. Get me? Don't get that twisted. Get me? So many commodities. Get me? So many business owners, entrepreneurs. Do you understand? So many different businesses. Get me? Let's keep it moving on. Let's go.
They look at what institutional investors do. What's your thoughts on that?
Institutional investors buy and sell things for different reasons. It's not necessarily they're buying because they think it's a good investment at that particular time, or it's not that they're selling because they think it's a bad investment. They could be selling because they've just found another investment and they just need capital to go somewhere else.
People have this perception that active managers don't beat the market. So then why do active funds still attract billions? What is that about?
Hey, listen, you see this intro music? It kind of reminds me of them old school Dipset, old school Kanye West type of rhythms. If you know, you know, innit? If you know, you know. Get me? Rockefeller, the Rock is in the building. Rockefeller Records. Let me stop. Get me? But if you're interested in hip hop content, that content's coming as well. Don't get that twisted. This channel is real versatile, yeah. My name is Versatile, aka I could be on trust name, could trust when it comes to orphans reactions. So here we go, let's go.
Welcome back to another episode of the podcast. I'm your host, Atto. We have a special guest in the building. We have Jacques, who's an investment professional with 11 years of experience in asset management, where he worked on institutional portfolios and gained a deep understanding of how money is managed at scale. Today, he's transitioning into financial planning, combining technical expertise with a passion for helping people build wealth in a more holistic way. Alongside his professional work, Jacques runs a social enterprise delivering financial education workshops in schools and youth clubs aiming to empower the next generation with money skills.
That is a
Now wait, that's a round of applause. That last part especially is a round of applause. But you know what makes me more intrigued as well is knowing how there's different aspects of when it comes to finance. Because I'll be real with you, growing up, I didn't know too much about money, and I still don't know as much as I want to know. And this is why I appreciate podcasts like this. Yeah, because it makes me, I'm learning more. And you know, if I can apply what I learn, even better. But you know, get me, that's the whole point. Like, learn, and if you can apply it when necessary. You feel me? So yeah, hit the subscribe button, turn on the post notification. Let's keep it moving. Yeah, man. But in fact, before you do that, leave an answer in the comment section below. When it comes to finance, what do you know? Like, what levels of finances do you know? Like, let me know in the comments below. Or what were you taught growing up? If you were taught.
fantastic opening.
Yeah.
That's really good. Wow. I'm doing good, man. I'm doing good. I think the last time I was here was probably a year ago.
Yeah, it's about, just over a year ago.
So much has changed. So much has
A
changed.
lot has changed in a year, right?
So I think back then I was in corporate. I was working for an asset management company. I've been in asset management for about 11 years now. But now things are a bit different. I've since left the corporate world temporarily, maybe not. And yeah, I've been on what we call a self-proclaimed sabbatical.
That's good.
Yeah,
That's
you know what I
good.
mean?
It's useful to do that, right?
Listen, I'm telling you, it's one of the best decisions I've ever made. So I've taken a summer off. So I think June the 30th or something like that was my last day at my previous company. Decided to take July off and August off. And potentially September as well. Enjoy the summer. My birthday is also in July as well. So I've had a fantastic.
Shout out to all the July bones. You know what I'm saying? July, but. Woo! Nah, for real. So wait, but this was, never mind. Let's keep moving. Let's go.
Summer, and as you rightly said, I'm transitioning into financial planning after my so-called sabbatical.
Okay. You know what? Before I ask you to describe yourself, people would want to know how comes you've decided to make that? Because obviously, him being are you allowed to say now you're investment manager? Right? Yeah. How was that for you? How did you find that?
Yeah, so my previous role, the one I did for the past 6 years, I was working in a portfolio management and implementation team as an investment manager. And I think that was a great experience. I mean, the whole industry of asset management has been a great experience in terms of learning, as someone who grew up in a lower socioeconomic background, learning about assets and the financial markets. And
you see, look, the fact that he mentioned he grew up in a lower socioeconomic background, this for me is one of the main reasons why it's important to share information like this, because whenever you come across it, or whenever I come across things like this, it makes me realize and makes me appreciate, you know, the journey that someone has made, because you don't know their beginning. Some may say, oh, well, you grew up in wealth. No, not necessarily. You know what I mean? And even those who grew up in wealth, some of them do not understand how to manage money. That's another thing. You get it? So anyway, but learning from this brother, I appreciate it even more so now. Let's see what he's got to say, because the beginning, to hear what he was saying, the intros that I say, and even the beginning intro, when he was talking about certain things, I'm like, wow, I never realized. Stick to one thing. But yeah, let's go.
how it all comes together. Fantastic experience. But I think when I look at who I am, what I enjoy, what I think I can bring to the world, I think is a bit more than working in corporate and managing institutional money alongside other professionals. I think for me, I'm very big on the individual. I'm big on families, and I want to be able to provide.
Stop drawing trend lines. Stop doing whatever a trader is doing. There's a reason institutional traders don't trade this way.
financial education, mentorship, guidance, regardless of who I'm dealing with.
Yeah.
Even from a professional standpoint as well. And I couldn't do that working in corporate asset management as well. And that's the reason why I'm looking to take this next step. And it's a self-employed role, so there's a bit more flexibility as well.
Yeah. It's so interesting because, you know, people have this weird misconception. Oh, you're on this nice cushy job. Why would you leave it? And people just don't understand there is more to life than just
Yeah.
Look, although this is a money podcast, it sounds so fun. There's purpose, right? And sometimes it's like, everybody has an epiphany when you're helping like a very wealthy company or rich individuals. They're like, actually, wouldn't it be nicer to just help somebody who's not rich, help them get rich? Right?
Do you know what?
That part, the fact that you mentioned purpose is everything. And this is the purpose of why I'm, like I said, my purpose of reacting to this content is because end of the day, yes, I'm interested in finance. I'm interested in wealth management and wealth building. I'm interested in business. I'm interested in all these things. Get me? Not gonna lie, I tried to do a business, it failed. Like, you know what I'm saying? I ain't afraid to say that. I tried, like, get me? But that's the reality of life, isn't it? Sometimes you can try something and it may not be successful as you may want it to be, and sometimes the idea can transform into something completely different. You understand? But aside from that, the purpose of me watching this and reacting to this is simply because it's hopefully other people can learn and see as well. Because the more people that see this, the better. You know what I mean? So keep it moved. Make sure you hit the subscribe button, turn on the post notification because more content like this is going to be on the way. That is for 100% certain. I've been meaning to react to finance content for a long time. Because before, when I started this channel, or when I started it was to do with music at first, and then I thought, okay, I'll get into business, entrepreneurship. I was talking about entrepreneurship, and then that wasn't doing as well as I thought it was going to do well. It wasn't doing as well as I thought. So then I did a change and doing music reactions. Then I realized, hang on, let me get back to reacting to about finance. Like, you know what I mean? Let me get back to that mode. Do you know what I mean? I can still react to music. I can still react to, do you know what I mean? Things that are trending within hip hop culture and the UK scene and stuff like that. I can still do that. I mean, the channel's called Real Versatile for a reason. Get me? It's funny that. But anyway, let's keep it moving.
You can get very comfortable, you know, being in the role and earning decent salaries and progressing, etc. And I think for some people that's perfectly fine. I just think, like you said, money is not everything.
Yeah.
It's very important, and don't get it twisted. It was a very difficult decision to make, especially when you are coming from, again, a lower socioeconomic background. First person in your family to go to university, you get this role that's in the front office of asset management companies. To leave it and to leave that kind of like secure income stream during a cost of living crisis, where you've got a mortgage and that kind of stuff, is not an easy decision. But the truth of the matter is, that's why we plan. So I knew I wanted to do something like this for the past few years, and so of course it required me to put some savings away, minimize my expenses, so that I can give myself at least a year runway where I can actually try new things, and that's what I'm doing.
That's important. And you see, like you said, you plan, right? A lot of people want to do things, but they don't plan for it. And you plan for this period of your life. So I think it's a very important message that people should really listen to. If there's something that they want to do, it really should. You're not going to get there if you don't plan for it, right? And do a bit of sacrifice. And now you're able to have the summer off, and now you can transition into financial planning, which is quite nice. Yeah. So, obviously I introduced a bit about you, but if somebody was meeting you for the first time, how would you describe who you are and what you do? Yeah.
So I'll say my name is Jacques Opoku, and I will always do the thing where it's like, it's actually Jacques. It wouldn't be French.
Jacques. Get me? Not Haitian Jack. Let me not do that. Alright, but if you're interested in the hip hop culture, you know what I'm talking about. You know what I'm saying? Haitian Jack. Trust me. I got content coming towards that as well. So if you hit the subscribe button, turn on the post notifications, best believe that content is coming soon. You know what I mean? Speaking of planning, I've been planning that. But truth be told, I kind of want 1,000 subscribers first before I upload that. You know what I mean? minimum 1,000 subscribers before I do it, before I get that content uploaded or I go live with that content. Like, get me to 1,000 subscribers first, and I'll do it.
Jacques Opoku, in terms of what I believe my purpose is and what I believe I can bring to the world in terms of service is I want to help the everyday person, the everyday family manage money. Basically, I want them to live their best life without money being the reason why they can't. And the way I try and execute this intention and purpose that I have is often within 3 segments. So the first segment will be my personal brand, which most people will know as Jax Financial. That's JAX Financial. And with my personal brand, I do a lot of speaking engagements. So I speak at churches, I speak at different institutions.
Jeez, speaking at churches, I respect that. Get me? I respect that. Let's go.
I do one-to-one coaching and group coaching as well, which again is similar to financial planning, but I can't tell people what to do. I can educate, I can guide, I can mentor, but I can't tell people what to do. And that's just financial, the brand. I'm able to be more flexible. I can do what I want, albeit can't tell people what to do. Yeah. But that's just financial. That's my personal brand. And then we have my social enterprise, which you mentioned in the introduction, which is called Woke Finance. We are going through a transition of changing the name and rebranding. But we got incorporated back in 2019, and it's a social enterprise that provides financial education, guidance, workshops for young people, often from underrepresented and disadvantaged backgrounds. So actually this summer, one of the things I've been working on during my sabbatical is Passion Project, where...
So if you want to make a remote income from home, and you're a beginner, meaning right now in a
listen to this podcast, basically.
Specifically this period, this year, we're working with a specific group of young people, which are like young offenders. So we've worked with like youth justice, we've worked with people that are exposed to gang violence and stuff like that. And we're still teaching them financial education. And that's what we've been doing with Woke Finance for the past 6 years.
I wonder if one day he will end up working with because he said youth offenders, and I immediately, not to say that those in foster care or after or leaving care end up, do you know what I mean, in those situations, but like, because I remember because I was raised in foster care, and I remember the after adolescence place where the after care, what was it called, after adolescence or something crazy like that. But anyway, next to it was a youth offender thing or whatever. So I'm just wondering, would he one day help those who are also leaving care? You know what I mean? Because I think that's also just as important. But let me know in the comments below. Do you think that's a good idea? You know what I mean? Because maybe, anyway, I've got ideas.
Yeah, and I've really enjoyed it. Really enjoyed it. So that's the second segment. Again, that's for young people, often between the ages of 11 to 21 from underrepresented backgrounds. And then the final segment is what we've just discussed, which is moving more towards a professional service, which is the wealth planning or holistic financial planning, wealth management, which I'll be doing through my next venture.
Wow,
So,
you're doing a lot.
Yeah,
Man.
so I tried to capture everybody.
Yeah, that's nice. Look, like all the best. I'm
trying to get to
like
everyone.
the other two. I know you're doing that currently, and that's great. And all the best of the financial plan. I'm definitely looking forward to hearing like what your experience is like with that. So thinking about your own journey with money, the emotion, lesson, and experience. What's one belief you carry now that you wish more people understood?
Yeah. Oh, I like that one. We're already getting to the thick of things. So look, I think probably from an investing standpoint, I am someone who consumes a lot of social media as well. I watch a lot of YouTube channels, and sometimes it's not very easy when you are a professional in the money management space and you hear certain things and you're like, oh, I disagree with that. I don't think that's right. And one of those things is, for example, everybody should invest in an index fund or an S&P 500 being the obvious one.
You're gonna trigger people.
I'm gonna trigger.
Let me leave your answer in the comment section below. Have you been told that before? That is, because it's funny. Because remember, he did say when giving advice, like financial advice, he can't tell them what to do. He can only give them advice. So, in this circumstance, when you think about it, those who say invest in an index fund or invest in SP 500, you know what I mean? There has to be a reason why they say it. But what's the reason? What's the purpose of why they're saying it? You know what I mean? Are they making money from it? Or just because they were making money from it doesn't mean that you're going to make money from it. Like, this is the thing about the financial world. What works for someone may not necessarily work for you. So, but, investing in, building wealth on any budget, that's where I want to learn more about that. Let's keep it moving. Let's see what it's going to say.
Got some people,
But it's funny because you're an investment professional. You're saying this,
and I have to be honest, right? So, now does that mean that's a bad investment? Absolutely not. It's a fantastic investment for the right person. But I think the one thing that I have learned over the many years of doing it professionally and as a retail investor myself is that the best investment that anybody can make is one that they can stick with. One that they can stick with, but also one that actually optimizes their objectives, their risk preferences, their risk tolerances and stuff like that, and their timeframes. If we don't optimize that way, often what happens is people will just listen to someone on YouTube, listen to even Warren Buffett himself, talk about things like index funds, and that's what they will invest in, ETFs, and that's fantastic. But often there's a reason why people don't stay the course, because unfortunately, it could very well be that they've invested in something that doesn't actually meet their objectives or doesn't actually meet their risk tolerances. And I'll give a very quick example before we move on, which is I've coached some people where one of the questions I ask them is, well, okay, choose a risk level between 1 and 7. And often you hear like 4, some people will say 3, but then they might have been investors already. So I'll say, okay, let's do a portfolio review. You've invested in, I don't know.
Did you know emerging market economies generate 65% of global growth? A guide.
VOO, QQQ, one of these ETFs that tracks an index. And I said, well, let's look at the fact sheet or the key investor information document, which is a document that tells you what the fund is all about. And if you look at the risk number, you will realize that actually it's probably 5 or 6 out of 7. And when they notice that, I said to them, well, that means you've not.
Wait. Time out. We're going to rewind that because he said something that made me realize. Because when I invested in something, in a stock, for example, or share, whichever you want to call it, I remember that word, and I honestly didn't know what the hell it was. I promise you, I didn't. And it's funny how you mentioned Warren Buffett. Because of Warren Buffett, where I got interested into investing into shares, but I didn't. Yeah, and even reading his book was a bit too much for me. Let me just try to rewind it. So. Let's rewind it from here.
People will say 3, but then they might have been investors already. So I'll say, okay, let's do a portfolio review. You've invested in, I don't know, VOO, QQQ, one of these ETFs that tracks an index. And I said, well, let's look at the fact sheet or the key investor information document, which is a document that tells you what the fund is all about. And if you look at the risk number, you will realize that actually it's probably 5 or 6 out of 7. And when they notice that, I say to them, well, that means you've not invested according to your own risk tolerance, which means what's going to happen is everybody's a long-term investor when things are going well.
Yeah.
But the moment we go through some sort of market volatility and turmoil, you are likely to actually sell out at a loss, which speaks to why a lot of people lose money in the stock market.
Okay.
So that's the answer I'll give you. The thing that I've learned is the best investment anybody can make is the one that they can stick with, but also one that optimizes their objective, risk tolerance, and timeframes.
I appreciate that. I think that's a really good one, and we're going to talk more about that. And we're going to talk about institutional investing and mindset, because I think it is important. And I'm glad that you called that out, because people have very strong opinions online. I didn't know how strong people's opinion was in the UK, not just the UK, just generally about investing, which is good. I always say it's good because it means that people are interested in investing. That's great. It means that you're engaged, you're learning about it. Yeah. But people have very strong opinions, and they're like, it's almost like factions warring, active versus index. And if you're index, you must do this. But I do appreciate what you're saying. At the end of the day, it's one that you can stick to, because things are going to change. Yeah. If you're investing for a long period of time, 15, 20 years, things are going to change, right? So you're right. It is really about something that you can stick to. And
the fact that you mentioned about the investing within 15 to 20 years, there's some people that invest with a mindset thinking things will change within a year or 6 months, 6 months to the year. They don't think properly long term. Because I swear Warren Buffett didn't become a billionaire until he was like in his 60s or something like that. I'm sure that was like we'll get into that another day. So make sure you turn on your post notifications. So when I go live, I react to that content. You'll be there to watch there and then. But I'm pretty sure it was in his 60s. That's when he became a billionaire. Yeah. So it just goes to show you about long-term investment. And he was investing in stocks and shares for what since he was what? Like a damn you, bruv. Like, you know what I'm saying? Like a damn you. Now imagine starting investment when you're a child, like using your pocket money. Do you know what I mean? Or money you're earning from doing chores or whatever the case may be, and you're investing that money. Like if you got kids, right? I would strongly advise that that's the best thing you can do for your kid. Just help them. Do you know what I mean? Help them invest in things that's going to help them make money, like double their money, triple their money in years to come. But anyway, let's go.
I think that's very important. XCB is currently giving new clients a free share in Rolls Royce when you open an account, verify it, and make your first deposit. And within a few days, that share is yours. I use XCB myself because it makes investing simple and affordable. You pay 0% commission when investing in stocks and ETFs, and you can earn up to 4.25% interest on any cash sitting in your account. You also get access to 10,000 stocks, ETFs, can start with as little as £10 and enjoy quick, secure, and free deposits and withdrawals. It's one of the most straightforward platforms I've used, whether you're just starting or scaling your investment portfolio. So, if you'd like to kick off your investing journey with a free Rolls Royce share, check out the link below or use code SAVVY and sign up today before the offer closes on the 30th of November 2025. Please note, the free stock promotion applies to the United Kingdom only. Your capital is at risk. The value of the stock may fluctuate. Limited availability. T's and C's apply. So my next question for you, right, is in your career, you worked with people at very different stages of wealth. So obviously, you know, being you an investment manager, what experiences stand out most to you, and what patterns have you noticed in how people approach building and managing money?
Most people think Bitcoin has one price, but on different exchanges, the price is never exactly the same.
Yeah, so I think, that's a great question. I think when you're dealing with individuals, families, institutions that have a large capital base, which is a lot of money, they know that they're good at making money, right? And I think there's something to be understood about. There's a difference between making money and managing money. There are some people that are very good at making money, but then
you see, he's right about. That he is right about. And I'll give you a prime example. Then again, I don't know him personally, but put it this way: if you're into hip hop, you would know the first person that comes to mind when it comes. Do you know what I'm saying? Let's put it that way. And I will do content in regards to that because there's something I really want to do or say. But let's go.
May not be the best at managing money. Yeah. And so those people, a lot of the time, the wise ones will actually bring on board a professional to help them through that process. But then you also get some people that are, you know, very good at making money, but they're fantastic at managing money too, right? They understand all the principles of, earn more than what you spend, or kind of invest the difference, etc. So is that mindset to understand that making money is one thing, managing money is another. Right. And it could well be that actually you may be good at one but not the other, and being humble enough to understand that, to then bring on board potentially a professional to help.
The funny thing about that is, let me leave your answer in the comment section below. I don't want to be completely honest. Are you good at managing both? No, sorry. Are you good at making money and managing money? So are you good at both, or are you good at the other, where you're bad at making money but you're good at managing money to a degree, which kind of doesn't make sense if you're good. But you know what I'm saying? But anyway, because there was a point in my life where I was very bad at making money, very, very bad, and then it got to the point where, you know, I guess I'm okay to a sense. I'm not where I want to be, but or where I feel I need to be, but wherever God wants me to be is I'll accept wherever God wants me to be, but I still will work towards where I want to be. And if God allows it to happen, God will allow it to happen. But I'm saying it to say this. Even there was a point where I was bad at managing money. Do you understand? Very, very extremely bad at managing money. Then I can't remember the name of the book. If I can remember the name of the book by the end of this stream or by the end of this video, whatever the case may be, I'll let you know. I'll let you know. Other than that, I will put it in the comments, and then you will know. But let me know what books you have read that helped you manage money, or you know what I mean? Because for me, there was this one book that helped me change the way I manage money, and everything just clicked like a light bulb, like this. You know what I mean? So now I feel like I'm good at managing money.
Through the process. And I also find that actually some of the ones that are very good money managers themselves will still bring on a professional to help them.
Of course, that makes sense.
Because of their time, right? They're very, they care a lot about the efficient allocation of time and their resources. So they know that they are better off doing something else. It's like being a driver but still having a chauffeur.
Yeah.
Right.
That's true. Yeah,
so they know how to drive themselves, right? But they will still bring on a chauffeur because they want a driver, right? And so those clients are interesting because when you sit in a meeting with them to talk about the markets and to talk about their portfolio reviews and performance, it's an interesting conversation, but it can be very challenging as well because they know their stuff. They really do know their stuff.
So they'll challenge you on questions.
Do you know what I mean? So there's that. And I think one thing I've noticed about wealthy people as well is they care a lot about the details. They care a lot about the details. They care a lot about tax planning. And you'd be surprised when it comes to things that maybe sometimes new money has deal with in terms of, you know, sometimes when it's new money and we don't really care that much about small things. They care about the pennies.
Okay.
Yeah, they really care about, you know, why is this being charged this way? Why is this being done this way? They really care about it. And I think that's something we can learn. Okay. And it's not so much about counting pennies and all that kind of stuff, whatever. But I think it's just the attention to detail that makes them very unique people. Yeah. That's something I've come across.
Okay.
Yeah.
This is what I like about these conversations because it just shows you, right? Like, and I do appreciate what you said about outsourcing, because at the end of the day, right, you're right, it does make you efficient. Just because you're outsourcing, that doesn't mean that you're incapable of doing that thing. Right? Like editing, for example, right? Yeah, I can edit. I edited when I first started, but actually to be able to make more of an impact, I need to do other things and get somebody to help me edit so I can do other things and et cetera, right? And I think that is, I don't know, I think with money, it's so interesting. We're going to talk more about this, but like, I think the way people feel like about financial.
What's the problem? Your gym muscles don't work for real life. Big muscles don't mean big strength, son.
If you want to look strong, go to the gym. But if you want to be strong, do military workouts. Let's be real. Most guys over 40.
Listen, if you want me to react to content like that, let me know in the comments below and I will react to content like that. That's got me very interested. What? And it kind of does and not make sense. I don't know, but I could be wrong.
Like managing money and making money, I think people think all of it should be free and you shouldn't spend no money on doing that. And yes, it's just easy, just put in a tracker and that's it, you're done. Let's not, spend. And I don't know, I'm not really...
You're not sold?
No, I'm not sold on that. No, because I'm thinking, if you're going to be making a lot more money, right? Do you really want to just be there? Like, because it's a lot of effort, right? To look at everything every month or every quarter. It's a lot of effort.
I mean, and this goes back to what I was saying earlier about choosing an investment style that best suits you.
Yeah.
Like, at the end of the day, I remember speaking to someone who, wants to invest for themselves, and I asked him what sum of money are you investing, and it wasn't a large amount. And I said to him, well, hopefully you grow a portfolio and you love this game so much that you can grow the portfolio to a sizable amount in the future, etc. But if you're going to spend all this time researching stocks and you're only investing a couple £100, even 100% return on £200 is just £200. And that's not guaranteed. And that might be over a long period of time. You might be better off driving Uber that evening. Do you go on?
Damn. Hey, when you put it that way, damn.
I'm saying?
Yeah.
So there has to be more thought in that conversation as to why we do certain things. And money is very sensitive for a lot of people. You know, people will share, I don't know, this might even sound a bit controversial, but people will rather share a bed with someone than share their money or whole conversations about money. People will talk about things that are very sensitive to them, to strangers online, on TikTok and these places. But when it comes to their very personal finances, it's something, yeah. And I just think that's just how money is, because money itself is not just this thing that has a head on it or it's just cash. No, it's a representation of a lot of things as a medium of exchange. Some people will say it's their blood, sweat and tears, so it's very sensitive. I understand.
Very sensitive. I do understand it from that perspective. So we want to talk about institutional investing, because we've never really covered that, right? And I think it's going to be so interesting for people. But before we go, deep into it, for the people that don't know, when we say institutional investors, what do we actually mean, and who falls into that category?
Okay, so institutional investors, I think it depends who you're speaking to, but I'll give you like an overall summary. Ultimately, you're talking about people that have large sums of money, and I'm not talking about individuals. I'm talking about organizations, enterprises, etc. So a lot of them will manage large sums of money, and I'm talking about tens of millions, maybe hundreds of millions, billions even. And often when they are managing money as well or investing this capital, it's on behalf of someone else often. So I'll just throw some examples of what we call kind of institutional money, which is we have like pension funds. That's institutional money, right? Institutional money. Different types of pension funds, from defined benefit schemes to defined contribution schemes. These are all institutional investors. We have the mutual funds. These are institutional investors. We have something called endowments, which is a fantastic area, I think, to learn about, which is a big part of my previous job, was managing endowment money. Universities have endowments, for example. We have sovereign wealth funds. So there are states, countries that...
listen, the list... The list, the categories under, institutional, funding or money or whatever the case is, it makes me really realize how much I do not know that much about money. Does it make you feel that way as well? Leave your answer in the comment section below, because this is why I'm here, to learn and share. Let's keep going.
Actually have their own portfolio. A very popular one, I believe, is Norway.
Yeah.
So different types, financial companies, banks, insurance companies, all these companies make use of financial markets, the stock market, to fulfill their needs. And these are what we call institutional investors.
Okay. And how do they differ to like us everyday investors, or the term is they call us retail investors? How does it differ to that?
Yeah, many different ways. One would be a sheer amount of money that they're investing, of course, is significantly much more. Institutional investors have very specific, unique, nuanced mandates. So they're really trying to achieve something specific. And I think retail investors can learn from that. So we can talk about that. So an insurance company's strategy, investment objective, and how they pick their asset allocation, etc., will be very different to, let's say, an endowment, right? And that would be very different to a pension fund. That could be very different to a mutual fund, right? And so that's important to understand. But also, there's constraints. There's so much you can do. So there's a lot of regulation when it comes to institutional money as well. Okay. So I think on the top of my head, those are the key differences I can think about. The fact that they've got a huge amount of money, they have very specific mandates and constraints, and very unique goals that they're trying to achieve for their institution.
Yeah. And what we say the main advantage institutional investors have over, because everybody thinks that, they have like brilliant people like you, analysts and stuff like that. But is there anything else that they have as a major advantage over everyday investors?
Yeah, I mean, first and foremost, I think access being a very key word in this. I think having that very direct access to let's say CEOs of companies. So I've had the privilege of sitting down with some CEOs, CFOs of some of the companies that people invest in, and listening to what they're questioning them, asking them questions. I don't do a lot of the questioning. I kind of just sit and let the main fund manager do a lot of the questioning, but listening in and listening to the information that they will give, not inside information, but just more information that you might only really hear in a conference call or earnings report, for example. So that access is very important. And even going further with access, also sometimes they benefit from, not sometimes, all the time, they will probably benefit from economies of scale, which is being able to buy in bulk, which also means there are certain assets that you can invest in as an institutional investor, but you can negotiate fees. So I'll give you a very simple example. You know, when you're buying like a mutual fund, they will have different share classes. Sometimes it'll be like a P or a Z or something like that. Sometimes we say accumulation, distribution. These are share classes. Institutional investors can create their own share class with that fund, which means they're still investing in the same thing, but their route into that fund is different, which means they might pay less fees. And that's because they are actually investing more money, right? Companies can also do something called private placements, which means they'll actually just go to the institutional money. They wouldn't even do it to the public. So there's all of that.
A lot of that one, the private one. Yeah.
Oh yeah. Do you know
Even doesn't that happen a lot with? Correct me if I'm wrong. Does that happen a lot with IPOs?
Yeah. So I think even when we talk about like private markets, which is a huge conversation that's happening in the industry right now, which is, for example, companies are staying private for longer, they're not coming to the public stock market as much as they used to, which opens them up to a lot of regulation, and they have to keep up certain things like quarterly returns and stuff like that.
That's interesting that you said that. That companies are not, they're staying private for longer rather than going to IPO, when some people's main objective is to get an IPO. Then it makes you wonder, when people are now starting a company, what is their objective? Do they want to, and like, does it benefit them more by staying private? But then I don't know, but then there's a lot of questions I want to ask, but let's see what.
But private markets is a huge conversation right now. But who has access to those private markets?
People got lots of money.
So it's institutional.
This is what I'm gonna say. The institutional investors, they're the ones who've got fund access to the private companies. So this is what I'm like. This is what I'm just so confused. Not confused. I'm like, all right. So if they, then okay, I'll get it. Cool.
The money, right? They can invest in unregulated, sometimes depends which institution, but they might have access to unregulated products like hedge funds as well. So lots of advantages that they have, but also some disadvantages too. We can touch on that as well.
What the disadvantage? Let's hear it, because this is no, I'm finding this fascinating because it just shows you, I think for a lot of people, right, it's obviously advantage and disadvantage. You mentioned mandate, which is quite interesting that they've got a mandate, which is quite unique, because I understand that they've got, but then that also means that that's a restriction, because you have to almost follow that mandate. Were they quite flexible in the mandate, or was it like, no, we're doing this for 5-10 years kind of thing?
They will have a very specific mandate that you can't completely deviate from, and that's all agreed on the outset, right? So you would write an investment policy statement, IPS, and that's basically like what we're going to do to do the mandate, to get the mandate done. So you can't deviate too much away, otherwise you'll be sat in that meeting explaining why you did something that probably didn't work, that was completely away from the mandate, and you can get in trouble for that. So remember, think of it like this, right? A pension fund has it's trying to, so for example, a defined benefit scheme, the whole purpose is nice, is long term, but they're trying to create a portfolio to match long term future liabilities. Which means in the future they are going to pay out. These companies are going to pay out
for when anybody needs their pension. They have enough.
Right. So you can't just decide, okay, even though you're a pension fund, a defined benefit scheme, we're going to put your portfolio on 100% equities. No, that's not going to run. Crazy, you can't just go and stick in the S&P 500, right? What you probably do is you will have quite a few government bonds, gilts in the portfolio as well, because that's how they're structured. They're very good for, and I know you don't like technicality, so I
don't like it. I like to explain it all.
But there's strategies like immunization and managing duration risk and interest rate risk and all this kind of stuff. But essentially what we're trying to do is you're trying to match the cash flows of certain assets, knowing that in the future you're going to actually pay out these cash flows. So you have to follow that strategy. You can't just go and start buying penny stocks or anything like that. Yeah.
Okay, that's so interesting. Now that you're saying this makes sense. So you mentioned insurance companies. So does that mean also insurance companies are also investing in a way to also pay out their liabilities as well?
Yeah. So insurance companies will be a bit different.
Insurance
Yeah.
perspective.
So this is what's fantastic about investing and why I love to educate, because it gives new perspective. So insurance companies will be different from pension funds in the sense that they require more liquidity. They require more liquidity because there could be claims at any moment. So again, their structure will be different because they need something available to pay our clients should clients claim. So their mandate will be different. And an endowment will be very different as well, because an endowment.
Just one thing why many personal transformation and personal.
Yeah, it's mad. It's mad when you think about the many different levels of investment. Do you know what I mean? Like there's different levels. Just when you think of there's one level, there's another level. Just when you think about that level, there's another level. Within that level, like, you know what I mean? Even if you go to one, I see it like the best way I'm gonna say it, and I could be wrong about this analogy, but I don't think I am. But you can let me know in the comments below. It's like a block of flats or apartments, yeah. So you have the ground floor, so you got that level. Then you got obviously doors within that ground floor. Do you know what I mean? And you can access those doors. But even though you can access the first floor, in some apartments there's literally codes on that door. If you don't know the code to that door, you can't necessarily get to that floor. You understand? So even within that first floor, so I say that first floor again, if you got the codes to it and you can enter, you can actually put yourself in a position where you can access other other doors within that floor, and then so on and so forth. That's what it feels like. Do you know what I mean? And let's just say there's I don't know, 19 floors, for example. You know what I mean? And knowing that, and now understanding more about investment and finance, I feel like there's 100 floors. You feel me? Like, how many floors do you think there is? Let me know in the comment section below. Get me? Let's go. You gotta make in finance fun. You know what I mean? Because I feel like with some people, you know what I mean? You get to a certain age, you know what I mean? Let's go.
The time frame for an endowment is into perpetuity, is infinite. So their structure, or what they're trying to achieve, is we're going to invest to benefit current projects that we're working on, or some of these companies are trying to pay out grants to students and stuff like that, but they also need to think about the future into perpetuity. So they want to make sure that their portfolio has growth in it as well, so they can take a bit more risk. So they will have maybe a higher allocation to equities than something that requires less risk. So notice all of these institutional investors I've mentioned are not the same. They have
and they all have different mandates. It's crazy because you just remind me. So University of Oxford was a client like about a year ago, and what I learned whilst I was working there was that I heard that they're so wealthy, or the uni so wealthy from investing, and that really blew my eyes. Oh my god, this is so crazy. But it's and what this tells me is that. And I think you kind of mentioned this in the first conversation that we have. A mandate is almost like your goal of what you're trying to achieve. And everybody has a different goal. So that's something that we can kind of take from institutional investing, right? What is that overall goal that you're trying to achieve? And as you mentioned in that episode, plug again to go and watch that one. What are you what are you investing in to meet those goals? And I think it's a very good way to think about it. I want to go back to something, gilts, because we never mentioned gilts. What is gilts?
Sorry.
No, it's fine. What is gilts? Because you mentioned bonds, and I'm going to tell people to go and listen to that episode. I'm not going to ask Jacques to say what bonds is. Go and listen to that. He explains that one. But what is gilts for people that don't know what that is?
So gilts are government bonds, right? So when we hear bonds, we just think of borrowing. So we can borrow to the government. We can also borrow.
When I think of bond or bonds, the name's Bond, James Bond. You know what I'm saying?
Or to corporate. So I think I might have explained that last episode that those are known as corporate bonds. But when we borrow to the government, because guess what? The government needs some money, right? Those things are called gilts, government bonds, essentially. And I think they're called gilts because historically, when they were in bearer form, which means it was actually a certificate that you can have to say that you've got this gilt. It was it had a gilt edge, so that's why they're called gilts. But essentially, you're borrowing to the government, and why that's important is because it's seen as somewhat, to a high extent, it's seen as a risk-free investment. You will get a decent yield on it depending on the interest rates. And it's something that makes a huge part of a lot of institutional portfolios. Government bonds and other bonds, the role they play in portfolios differs. As I said earlier, if you're trying to match liabilities and stuff like that.
If you want to make a full-time income from working part-time, you need to know this one concept because
it can serve that purpose. But also when you add government bonds and other asset classes to your portfolio, you have a portfolio perspective, and bonds allow for a much more smoother journey when you mix it in with equities. And that's what portfolio management is really about. If you have a 100% equity portfolio or stock portfolio, like an S&P 500, is going to be more volatile than if you had historically we had the 60-40. That was the most popular one, which is 60% in stocks, 40% in bonds, because if you have that, the journey will be much more smoother. It will not be as volatile as just having stocks.
Yeah. And this is an interesting question because, everybody I think is prone to mistakes. I don't think there's anybody that's like infallible, but I'm going to ask you anyway. Do institutional investors always get it right, or do they make the same mistakes individuals do, just on a bigger scale?
That's a great question. I mean, of course. I mean, mistakes are mistakes, and I guess it depends what kind of mistakes we're referring to. Do institutional investors always outperform the market? No, that's most definitely not true. But do they often create a portfolio that is there to optimize the client's objectives? Yes. But of course, that's why you have to meet the client often and discuss what's happening in the portfolio. Do we need to adjust? A lot of institutional investors will also do something called tactical asset allocation. And I'm going to explain what that is. So normally you have something called strategic asset allocation, which is part of the initial process. I might have mentioned this last episode, which is we decide, okay, we're going to do 70% equities, 30% in bonds. Let's keep it simple. And that's that portfolio we've just discussed is optimized for what you want to achieve, right? But it could well be that, as we do some macroeconomic analysis and we listen to what's happening in the market, we think maybe for the next quarter or next 6 months, maybe even a year, we think that equities will outperform bonds, or actually bonds look like they're of good value right now, so we want to do a bit more bonds. Then we might tilt the portfolio. We might be tactical and say, actually, we might do 65% this time in equities and 35% bonds, or go the opposite way, do 75% equities and 25% bonds. That's fantastic, and that sounds all great, but it may not work. It may not work, and often people get it wrong. Investors get it wrong. Institutional investors get it wrong. Things don't always pan out how you would have thought. Maybe you thought that interest rates were going to go down, but it didn't, and that affects the portfolio mix that you thought was going to do the best.
Okay, and how often is that happening?
Wait, that's not necessarily a mistake when you think about it. That's just if you're investing in something, it's risk versus reward, isn't it? So if the risk didn't pay out, the risk didn't pay out. That's that. I wouldn't necessarily call that a mistake. You know what I mean? A mistake is when, I don't know, an investment manager for the institutional investors for one of the many levels or many doors, should I say, they basically accidentally. When I say accidentally, they, you know, where their instincts may tell them that this may not be the right choice, but they pick it anyway. That is a mistake. Do you understand? But anyway, let me know your thoughts in the comments below. Like, what would you class as a mistake when it comes to institutional investors? Even if this is the first time you have heard of this term, because this is the first time I've heard of it. I won't even lie to you still. But from what I'm understanding, come on.
That tactical switch and, thinking about that. Yeah.
So in previous companies, particularly the last one I worked in, it was happening on a quarterly basis.
Okay, so every quarter.
Every quarter.
Is it like in our...
Do not buy more XRP because you could be earning 3 to 8% monthly returns on the XRP.
In the retail, because I try and translate to the retail, we often talk about rebalancing your portfolio. Is that, would you liken it to something like that? Rebalancing in a way? Or?
Yeah, you're it's probably the opposite of rebalancing. You're adjusting the portfolio mix to try and capture what you think is going to do well over the next quarter or 6 months. So what rebalancing ultimately is if you've got your strategic asset allocation, and because the market moves as it does, it comes out of kilter, right? And then you rebalance back to your strategic asset allocation so that it still remains how you wanted it to be. And that's great because you're essentially taking profits from the ones that's done well and you are buying the ones that haven't done well at a cheaper valuation. Ultimately, that's what rebalancing really is. And in theory, that should end up in our performance. So rebalancing is good for that purpose, right? But tactical asset allocation goes one bit further to say, actually, it's not just about rebalancing. Actually, it might not even be the right time to even take profit. Actually, we think it's going to go further. So let's keep this next asset allocation for this period not too far. And I just want to mention that because remember, the mandate will tell you how far you can go.
Yeah.
The mandate will be like, actually, you can't go further than 5% overweight.
Hang on. So let me get this clear. So does that mean even outside of institutional investment, does that mean there's a mandate for those as well, for those type of investment? Because it kind of would make sense, and I get why he's talking about strategic strategy, because I liken it to sports. For example, like football, it's like the manager of two managers have their, they have their tactics, and what tends to happen is they try to play the tactics that they think will win them that match or get the result that they believe they can get with the squad that they have. And you know what I mean? So it's very interesting, this though. Let's keep moving on. Let's go.
We discussed will be our strategic asset allocation.
Okay.
So if we say, all right, cool. Based on what you're trying to achieve, 70% is what the equity element is going to be. But we think equities are going to do really, really well because of the big, beautiful bill and all these things that's going to go well. Then we can go only up to 75, even though maybe I think at this moment we might do well going up to 90. Your mandate says this is a range. You can't go above that.
Okay. Wow. Yeah, this stuff is there. This is so fascinating to me. Is there like, I know this might be different for like different, funds or firms or institutions, let's say. Is there like a minimum, I guess, company size that they can invest in terms of like the valuation?
That's a great question. Do you know what? Actually, that speaks to one of the disadvantages of being an institutional investor, which is, think of someone like Warren Buffett, right? Warren Buffett himself, if he's invested for his own account, will be a retail investor, but he manages Berkshire Hathaway. Berkshire Hathaway is an institutional investment, right? Or investor. And so, using him and as an example, he can't just go and buy shares in small cap companies because he will end up buying the whole thing. I mean, he does. Ultimately, he does, right? And so yes, it's true that when you are an institutional investor, ultimately you have to know what you can buy and what you can't buy. There are some mandates that will say you only stick with large cap equities, which is only large companies. But also, yes, if you are investing in companies that are too small, you take too much of a majority stake. Okay. The flip side to that is that could be part of the objective, what you're trying to achieve. So previous companies that I worked for, investing in socially responsible companies was a big thing. Stewardship was a big thing. And so you would take a position in a company so that you can actually speak about where you think they should go in terms of their stewardship, their environmental, government, and social responsibilities.
Okay.
So
I'm not gonna lie to you. Till this day, I always thought that was cap. Not saying that he's capping. I'm just saying, when you hear some companies talking about taking social responsibility, this, that, and the third, I always thought it was just cap, just to make certain people happy from what they're seeing and reading. But no, some of them are actually serious, and I salute them for that. Yeah, man, let's go. Put the subscribe button, turn on the notification.
So that's another benefit of being institutional. So benefits and costs. Benefit is you've got so much money, you can take a majority stake, or maybe not a majority stake, but a sizable stake in a company, so that you can actually have influence as to what policy is taking place. And I'm sure you've probably heard of like activist investors who actually go and do that so that they can make change.
Yeah, some of the serious ones. Yeah, I've heard some of them like even trying to get people.
Wait. Ato, sorry, please, before you continue, and Jacques, please, before you continue, I need to just say this, and this is no disrespect to activists that go out and do their thing. Salute to everyone that does what they can, but it really is annoying and jarring when, in fact, no, let me not use that word. It really is disrespectful to those that also do care about what they're protesting against, but there's certain protesters that would do like, for example, they would take up the whole of a particular road where they know it's going to cause traffic. They know it's going to cause traffic, and that's the only route that they can go. Like the people that are not in the protest or whatever, that's the only route they can go. Do you see what I'm gonna say? It's like, yeah. Sorry, I had to get that off my chest. I had to, because that I don't understand. But if you're protesting and being active in a way where you're saying, okay, if I invest in this and invest in that, then I can make a change. All right, cool, bet. Get me? To me, that's activism, because you're active. That's really being active, because but there's many ways to skin a cat, as they say, but we don't skin cats. We respect animals around here. Yeah, but let's go.
Yeah. Like CEOs and stuff like that. Yeah.
That is crazy. So I wanted to also talk about the different styles, right? So what are the different styles of institutional investors that you know of?
Yeah, big conversation. Yeah. So it depends on what I've given you some examples already. Yeah. So an insurance company, a pension fund, an endowment, a sovereign wealth fund, they will have different styles of investing, right? Because they will have different mandates, things that they're trying to achieve. Yeah. There are some investors that will focus much more on the whole kind of, example I just gave you was charity investments. Charity is a big sector, by the way, and I don't think retail investors even know about this.
Not really, no.
Yeah, it's huge. I would say probably my last company was one of the biggest. It was probably our biggest book of clients, right? I'm a Christian, and I talk about churches. Churches have huge mandates as well, right? They have investment portfolios. People don't know that, but their strategies will be different as well, in the sense that, look, if you want an endowment, you're trying to generate cash flow. Yeah. Right. So you invest in bonds, you invest in maybe dividend paying companies, but also if you're an endowment, again, like I said earlier, the time frame is into perpetuity. So you need growth. You want to generate growth ahead of inflation, because you're trying to keep this endowment until you're gone, but into perpetuity. So your asset mix will be very different as well. There's people that will focus on some institutional investors will focus on things like factor investing. Some of them will look at, okay, I'm doing jargon again. Let me start again. There are some institutions, and I'm actually talking about investment companies, who their strategy will be, let's say,
did you know emerging market economies generate 5% of global growth? Our free guide,
top down. And I'm going to explain what that is, which is they will look at the macroeconomic environment macroeconomic backdrop and say, based on what's happening with policy, geopolitics, whatever, we think this asset class would do better than this, etc., etc. And that's a starting point. Based on that, they will then move to that strategic asset allocation I was talking about, which is, okay, now we'll put X amount here, X amount here. And then post that, they will do the whole kind of tactical asset allocation. And then post that, they will do something called stock selection. But even before stock selection, I'm giving so much information. I hope the listeners are enjoying it. Which is, they might even decide what sectors they're going to go into, right? So in the equity world, there's like 11 sectors. There's financial companies, there's communication companies, utility.
Wait. You see, what did I say earlier? I said this financial industry is like, it seemed like there's if we're going to compare it to a block of apartments or an apartment block, it feels like there's 100 floors. He just mentioned 11 just now. You don't say floors, but you know what I mean? Let's keep it moving. Let's go.
And these sectors behave differently to what's happening in the macroeconomy. So financials and others might be cyclical, which means they respond to the environment differently. Some may be more interest rate sensitive, like real estate, like REITs. REITs are real estate investment trusts. They're very sensitive to interest rates. So based on that macroeconomic viewpoint, you also decide how you're going to do your stock selection. But then there are companies such as Warren Buffett, institutional companies, which are not macro or top down. They're more bottom up, which is they're focused much more on the actual businesses. Right? They're value investors. They're looking at the actual company's financial statement, their balance sheet, their income statement, the cash flows. They meet the companies. And
this is why it's important to watch these type of stuff and understand, because many people would want to get into investing into stocks and shares because of Warren Buffett, but they don't understand what he actually genuinely does. Do you see what I'm going to say? They don't understand his actual strategy. They don't understand. You know what I mean? They may understand to a certain degree where he started, but they don't know how he pivoted. You know what I mean? Many people are not aware of that.
They're much more focused on the actual company and they don't really care what's happening in the macroeconomic environment. So again, huge topic, and we could spend a whole episode talking about the different strategies, but I've just kind of given you how a lot of the portfolio managers will function.
Thank you. No, I appreciate that, because that is very important, I think, to understand like how those strategies like differ to what we do as retail investors. And you know, another thing I noticed, and I don't know if you've seen this, a lot of retail investors, not when I say respect, they look at what institutional investors do. What's your thoughts on that? Like, so for example, let's say, let me say Tesla. They'll look at, like a lot of institutional investors are investing in
I see what you're saying. Yeah.
So therefore is a good bet. What's your thoughts around that whole rhetoric? Because that kind of does impact how we invest as retail investors, right? Because it might give you a level of confidence. Like, okay, Warren Buffett's invested in it, so therefore should be a good investment type of thing. Do you get what I mean?
I fully get what you're saying. So I think is it 13F filings? I forgot the actual terminology is, but a lot of institutional investors are required to speak about or let people know what they invested in on a quarterly basis. And so there are some people that actually will look at these things and say, "Oh, Warren Buffett bought shares in Apple, or he sold shares in Apple, so that means I probably should do the same." And I can understand the very simple mindset of why someone would think that. But I think it's very important to understand that institutional investors buy and sell things for different reasons. It's not necessarily they're buying because they think it's a good investment at that particular time, or it's not that they're selling because they think it's a bad investment. They could be selling because they've just found another investment and they just need capital to go somewhere else. It could be that they're just rebalancing their portfolio, not because not because they don't think it's a good investment anymore. If it's a fund like a mutual fund, there's mandates. You can't hold more than, let's say, 10% in a single stock. So they might be selling because we're too close to the 10%, right? 7%. So we're selling down to 8% so that we don't go overboard and breach our mandate, right? So you have to be very careful as to why someone is selling or someone's buying, I know the reason behind it. Using Warren Buffett as another example.
No, see, I like how he's saying this, yeah, because again, I'm going to use a football example. It's very much like I'm going to give two football examples here. For example, you got a team that's being successful using one particular tactic, yeah, and then other teams try to emulate that because they see that team, the original team, using that tactic for years, and they feel like, okay, they've been successful with that. Let's try emulate. They try emulate, but it doesn't quite work. Another football analogy, or whatever the case is, or comparison. And a team could have, for example, they could have an owner that invests well. Yeah, they invest well in the players, they invest well in the management staff, the coaching staff, and everything. And yeah, it may take about 2 to 3 years for them to really properly settle, right? And then they end up being somewhat successful, winning trophies, this, that, and the third. Now, there could be another team doing the same thing where they have an owner who's invested heavily, like financially, bringing in good players, but they don't bring in the right type of manager, or they bring in a manager that was doing well, and then they end up getting rid of that manager and replace him with a manager that doesn't do as well as they expected or hoped in the time frame that they wanted. And that's the key thing, time frame. And I think that the same thing also applies with obviously this investment stuff, because you got to look at it. If you're following someone else's tactics, because just because it worked for someone else doesn't mean that it will work for you. You know what I mean? It's that simple. Let's go.
It's a huge company with so much cash, so they can't go and invest in everything. There's a reason why Apple is their preferred investment, or holds a big weight in their portfolio. Of course, they believe in Apple. That's why they've invested in it. But because Apple's such a big company, by them investing a lot, it doesn't move the market against them, right? So it's important to understand these things as well. Does that mean retail investors shouldn't pay attention to what institutional or what they call smart money is doing? I think you can pay attention. So if someone like, I read someone that came into light was Bill Ackman, who manages, I think it's called Pershing Square or something like that. He's taken a big stake in Uber, for example, and that's interesting. That's I think for me it's interesting, and you should use those opportunities to just think, oh, if he's doing it, maybe I should go and do further research to see why he is interested and whether it actually matches my objectives and what I think as well. It could well be that, because they get it wrong, like you were saying before. Bill Ackman himself, if you go and listen to his story about times when he nearly went bankrupt and situations where he faced, even when he was going through his divorce and stuff like that, you would realize that they don't always get it right. Because guess what? Nobody has a crystal ball.
Exactly. Exactly.
Nobody has a crystal ball. So to answer your question, I think is interesting to pay attention to what smart money is doing. But it should be used as just an additional piece of information that we can add to our inventory to say, okay, if Bill Ackman's buying Uber, then okay, maybe I should be looking at Uber as one of my many different stocks I'm researching.
Okay.
Keyword researching.
Call your attention to an earth-shattering changes happening in our society that an era of AI. Are you using it?
I appreciate that, because I think it's important to just state that and talk about that, and it's good to get it from your point of view and what you think, because honestly, I think it's good, like you say, it's good that, oh, that's interesting, let me do further research, but your investment strategy shouldn't be based on that.
Do you know what it is, bro? What you can watch two very well-known investors, and they could be doing opposite things. So what do you do then?
Exactly.
Right. Again, you don't know why they.
You see that again. Let me use a football comparison. Two teams could be doing well, very, very well, but they have different tactics, different strategies. You understand? Let's keep it moving. Let's go.
Doing it. That's something that it's mindful of.
Exactly, like you say, you don't know the reason why. Everybody, like you say, everybody has their reasons why. Liquidate, whatever. Maybe I need the money. Look, Christmas is coming. I don't know, right? Whatever it is, right?
No, you're right. Look, there's times where they might just be liquidating because if you're following like a mutual fund or someone who's managing a specific mandate, because the clients ask for money.
Yeah.
And they need liquidity. Yeah. So they need to sell just to raise cash.
Yeah.
It's not because they don't like an investment anymore. Yeah.
So, over 70% of people who watch these episodes are subscribed. If that's you, hit the subscribe button. It really supports the channel, it helps it grow, and most importantly, lets us keep bringing you valuable conversations like this one. Plus, you'll be the first one to know when new episodes drop. Thank you so much for your support so far, and enjoy the rest of the show. Are there any other lessons that you think us everyday investors can take from, institutional investors? We've talked about a lot, to be fair, so there's no more, but yeah, it'll be interesting to hear if there's any more.
No, I think it's really this. I really want to nail this down, and I think if there's anything listeners can really take from today's episode is, we should be investing according to what we're trying to achieve. It's not just about dividend investing or growth investing or index funds only. It's not really about that. It's understanding and learning from even institutional investors that actually we should all have mandates. We should all have our own investment policy statements to say, why am I investing in this? What is the purpose for this specific investment? What am I actually trying to achieve with this investment? And is the portfolio that I'm constructing optimized in such a way that I can actually meet this goal? If you've got less than 3 years to invest, you shouldn't, in my opinion, be in equities, because equities are volatile. But if you've got 20 years, then damn, yeah, you probably want to be majority in equities. And that's just based on theory and history. However, even after that, it could very well be that you as an individual, you're not built for this. You're not built to deal with the volatility.
You're not built for this, bruh. Now, for real, some people are not built for it. But if you want to be built, and don't try to put yourself in a position where you're watching this, you're like, yeah, I'm not built for this. No, don't ever do that. Just do research, because you never know what you're built for until you actually put the action in. You know what I mean? You just never know, because the one thing you do may be the thing that you end up sticking with because it literally works. You know what I mean? And sometimes the thing you may do may not work, but then you find another strategy and then that works. Now, I'll give you another one. I got example of football and comparison. I remember, what season was it? I can't remember the actual year now. But either way, it was Chelsea Football Club. Yeah, as you know, I'm a Chelsea fan. But basically, I remember, I can't remember who we played, but I remember we lost against them. That season, after that game, I don't think we lost that many games. We ended up winning the league. Do you see what I'm going to say? The manager changed the tactics. He changed the way we played to the point where we ended up winning the league. And before that, it wasn't even looking too good. Do you see what I'm trying to say? So sometimes you got to change the tactics if it's not working.
And I say that carefully because even as a retail investor, and I mentioned this last episode, that I built a portfolio to 6 figures, and then it got to a point where I was like, actually, my risk tolerance is not what I thought it was, because the volatility was now really starting to affect my own emotions, right? And so the analogy I want to give here is,
okay, use my analogy.
Let's say we're both trying to make it to Bali. We both want to travel same day. We're both trying to go to Bali, and we have 2 different planes. One is a big plane, huge plane, and one is a small jet, private jet. And I'm not sure if this is actually true, but for the sake of the analogy, let's assume that big planes are less turbulent than small planes. I think my common sense tells you that should be the case because of the wind and stuff. It could well be that because you have flown so many times in your life. By the way, I don't like flying. I've traveled to many countries. I fly. Yeah, I fly.
I travel a lot.
I fly a lot, but I've never liked flying, right? And I most definitely do not enjoy turbulence. And so because I don't like turbulence, you might say to me, or the flight attendants might say, if you take this smaller plane, you will experience quite a bit of volatility, but you're going to get to Bali much faster. Than if you take that big plane, it's going to be much slower, but you won't feel the turbulence. The question is, which one do you go for? Some people will be like, I fly all the time. I fly private jets all the time. Let me get on a private jet and volatility, whatever. I've flown so many times. I'm good. they'll take that private jet, they will get to Bali faster. But Jax, yo, I'm taking that big plane. I don't want turbulence. Even if it takes me too.
I said, big man, that ain't for me. The private plane, that's not for me. I don't care about getting there quicker. I'll get there when I get there.
3 hours long, I'll rather take that plane because I don't like turbulence. That analogy is very, very important to understand, because investing is just like that. Okay. The reason why people invest in assets that may have that mix of bonds and stuff like that is because that journey is just smoother. And if you do that, and you and like what I said earlier, the best investment is the one that you can stick by, because guess what? Some people get into that private jet not knowing that it's going to be a very shaky ride, and guess what they do? They fly out, they jump out. Some people even blow up their whole portfolios and never fly again. Never get back into the portfolio, never get back into stocks.
Yeah.
So you really have to understand why you're investing and what you're trying to achieve, and make sure it is aligned with your own risk tolerance. And that can also come down to, you know, they talk about your capacity for loss, your experience, your overall wealth. Some people have so much money that if the volatility, it doesn't even touch them. Whereas if you've invested all your money, you've worked many years, like I did, the example that I used, and that 100k portfolio that I built was my entire net worth, then actually I should not be a 100% equity portfolio. I can't handle the volatility.
It's important. It's very important. It's very important. And thank you for the analogy, because I think that explains it quite clearly. And actually, I wanted to ask you a follow-up question about, you know, people blowing up. Because I actually got a stat, right? So it's I'm going to say according to several studies, because I think the stats vary amongst, you know, different places, but generally speaking, right, they say that more than 70% of retail investors end up losing money. Why do so many people struggle to make money in the stock market? And I think you talked about people blowing up their portfolios, but yeah, can you kind of, you know, even through your experience of helping people do portfolio reviews, you investing yourself, stuff like that?
So it's not that people don't make money, it's that people make money, but they also lose money, and they lose more money than they make. So what I mean by that is, I've answered part of this question already, in the sense that it's because people don't invest according to their own mandates. They don't create portfolios that actually meet their objectives, their timeframes, and their risk tolerance. And so everybody seems to be a long-term investor when things are going well. It's only when the stock market starts to take a correction or goes into bear market territory that you start to realize that actually most people that said they were long-term investors are not long-term investors, and they sell at losses. So I think I'll probably say that's the majority. The second one is what I spoke a lot about in the last episode, which is to do with our behavior. There's a huge study when it comes to behavioral finance, behavioral economics, and how people behave. And in fact, actually, that's what economics really is. It's a study of people's behaviors. It's a social science. Because the truth of the matter is, I can't remember who coined it. It might have been Adam Smith in a book called The Wealth of Nations, I think. But he talks about the animal spirits. It's the animal spirit. When the first time I heard it, I was like, whoa.
Wealth of Nations. Noted. That's a book I'm going to have to kind of read. You know what I'm saying? Wealth of Nations. What other finance books or economic books that you're aware of? Leave your answer in the comments below.
That sounds a bit scary. That sounds like some Nollywood animal spirits. But no, the animal spirits and the way it manifests is often through, the way I see it, is often through greed and fear, right? So what do we do when we are in trouble? We are either going to fight or flight. So that, being anxious and stuff like that. And a lot of the time what happens is when the stock market is going up and things are doing well, and whether it's stocks, whether it's crypto, whatever the asset class is, whether it's property, people get excited and they pile into it. If talking about property, think about over the past pre-2020, pre-2019, how many people over-leveraged, got so many properties. Everybody started a property company. Let's be honest, right? Why? Because, and the truth is, they never really understood the reason why property was doing so well was because the macroeconomic backdrop was good for all assets. There was asset inflation, right? A low to no interest rate environment, very good for property and very good for other asset classes. But a lack of education means that they're over-leveraged. And leverage is also a big problem. Even in the stock market. Many people go into the stock market and they want to do things on margin. They want to do option trading. They want to do spread betting. They want to do something called CFDs, contracts for difference. They really try their best to make as much money as they possibly can. And that gambling mentality causes them to lose money over the long term. The house always wins long term if you're going to gamble.
Exactly.
Right?
I was going to say the same thing. The house always wins when it comes to gambling. So it makes you wonder. Investment, is a gamble, but again, research.
May make some money in the short term, but over the long term, it's unsustainable. It goes back to what I would want to remember. The best investment you can make is the one that you're going to make positive returns, but the one that you're going to stick to for the long term.
So do you think that the investment strategy that you feel like you're going to stick to will make you more stoic on both sides? Do you think that's going to make somebody a bit more, because what you're saying is, you're right, it's down to a lot of emotion. I mean, don't get me wrong, if my portfolio is up, I'm happy, but you're right, like if it's down, I don't feel as...
We run your prop firm challenge for you and you until it's passed. Then we hand you a portfolio of automated...
I'll say I'm more clinical when it comes to it, generally speaking. So how can people be more clinical and not blow up not just blow up their portfolio, but just leave the stock market? Because leaving the stock market to me is like, it's a travesty, right? Like,
it's sad. For me, it's sad.
Yeah, it's sad, right?
Yeah,
like,
because it's the number one wealth builder.
Yeah. And you're leaving it because of, don't get me wrong, it's bad. Like you've maybe lost everything, or you lost a huge part of your portfolio, but what's the alternative not to do it?
Yeah, so I think one thing people can probably do practically is maybe go and take an online risk profiling questionnaire that will kind of tell you your own kind of risk tolerance level. That will be very, very useful. Another thing that people can do is only invest money that you're happy to see volatility on. So don't look at your investments as in isolation. I told people to look at everything from a portfolio perspective, right? So even your home is part of your overall portfolio kind of thing. So you look at your asset allocation, how much is in property. Don't look at it separately. And that can help you to understand that actually maybe you've got too much invested in the stock market. And then just try some mental gymnastics. I give you an example. I tell people all the time, close your eyes and I say, wherever you've invested right now, just imagine it going down by 30%. If you want to do the maths, get a calculator out, wherever you've invested, multiply by 0.7. Look at that number. How does that make you feel? If you saw your portfolio drop to that number right now, how does that make you feel? And if it makes you feel some type of way, you need to adjust that portfolio, right? And maybe go into more cash type investments or lower risk investments, and stuff like that. So consistently doing that will help. Another thing that I've done in the past, and remember, I'm doing this even as a professional, is I've got accountability, right? I've got a friend who I run Woke Finance with, the social enterprise, and whenever I'm buying stocks and that kind of stuff, I discuss it with him, right? And he keeps me grounded because I'm a human being. Listen, we are human beings. Our emotions can be our deciding factor most of the time. Where AI is going up, everyone's investing out. I don't want to miss out on this trend. I don't want to miss out on this new currency.
And then when it goes down, hey yo, I get it.
See, or crypto that's come out, you jump in it because guess what? Nobody wants to miss out. We all have the fear of missing out. That's the truth, right? But if you cannot explain to a 7-year-old why you're investing in something, the chances are you're not investing. Like I said, you are gambling.
Yeah. It's like,
raw. If you can't explain to a 7-year-old why you're investing, you're probably gambling. Okay, our words, our context, but you get the point. That's
it's really just playing on that. People have the goals. I want to be rich. I want to be financial freedom. And you got this thing that's making other people financially free. Are like, I don't want to miss out on that opportunity to be that.
I want to talk on that very quickly, because I think it's so important, so important for people from, and I use my demographic, people that maybe your first generation, first person in your family to own a property in the UK, first person to maybe work in a certain job in banking or whatever it is and earn a certain amount, you don't have the experience that other families do.
Yeah.
And that provides a potential problem in the sense that you may be trying to catch up.
Yeah.
And you're trying to catch up by trying to get on a fast vehicle, the private jet that I mentioned before, because that's the thing that's going to get you there faster.
Yeah.
But because you have no experience being on this thing, you're flying something that you're not used to, the moment you experience that volatility, you're going to jump out, kind of thing. So actually, I submit to you that actually most people that are building wealth for the first time in their families probably need a more reserved approach, because that approach probably is the approach that they will actually stick with, kind of thing. And that's one of the things that I've learned over the time. My portfolio management now is less so in kind of small cap, high volatile stocks. No, especially now I'm on my sabbatical, my portfolio is significantly in something called money market funds, because it's low risk. And regardless of what happens in the news, it doesn't touch me, because the portfolio that I've constructed for myself now completely matches my current situation and what I'm trying to achieve, which is still very different from when I was single, didn't have a mortgage, living in my mum's house. The strategy was very different. But even though theoretically I was positioned to have a more risky portfolio, because I didn't have the experience of volatility, I almost jumped out. And luckily, to be fair, I actually did it before the 2022 borderline kind of almost stagflation period where we had high interest rates and stuff like that. So,
It's interesting you say that first generation wealth builders should try to be more steady, which, you know what? I get what you're saying. I'm not going to say I completely agree. I get it though, because I think it's down to capability, like you say, right? If you do go on the thing that's too fast, the cryptos, I would say stock investing, single stock investing. So if you don't even know what you're doing, you're right. You're likely to blow yourself. You're like, oh, rubbing your hands, getting there. Oh my God. Maybe it goes up a bit and you're like, oh, this is nice. And then, you know, it goes down for a while. I remember, you know what? I don't know if people knew this, but I invested in crypto a long time ago. It was 2017. I didn't keep on investing, but my portfolio at one point, I'm pretty sure, like, my Bitcoin and Ethereum was down 80-90%. If it was money I needed, right? I've spoken to other people that had invested around the same period and said they took their money out.
Yeah.
Like, no,
but that's because your temperament was different.
My temperament was different. Yeah, I was like, you know what? Let me just see what this thing will do.
And that was it. And you didn't invest your life savings.
Yeah, no, I didn't.
So it's when I talk about people being more reserved, it's more about having your overall portfolio structured in such a way that your needs are taken care of. Right. So you've got, we talk about emergency funds and whatever. And then of course, like my favorite investment style for the average person and for myself is what we call a core satellite approach, which is whatever your capital base is and how much you've got to invest, take a large percentage of that, 70%, and invest in, it could be index funds. It could be anything passive, whatever. It could be a mutual fund. It could be I prefer multi-asset index funds. Or it could be some sort of target retirement type of fund. And just let it do its thing. And then the 30% or 20% you've got left, do you know what I mean? Have some fun with it. Right? Because if you blow that up, at least you still got the rest available.
Exactly.
Right?
So did you say 90? Was it?
I said 70-30.
70-30. Okay.
There's no right or wrong answer. I think you can decide how you want to do it. And I guess this is why I talk about people even needing financial planning. Everybody's situation is so different. You know, there's nuances, there's unique circumstances, context. So there's no one size fits all. But I think the key thing is, and I want to say it one more time, the best investment strategy is the one that you can stick with, because guess what? You stuck with yours. Whereas other people didn't. So the question is why.
And I still got my Bitcoin. Yes, I still got that there till today. So, okay, so if we're talking about strategy, how do people figure that out? I like the core satellite, actually. And I think that's a very good example. How do people figure out what strategy works for them?
Yeah,
because that's the tough part.
It's a tough part.
That's the tough part to see. For you, you've discovered it, but you were also, if I'm being very honest with you, you were real with yourself. A lot of people might not be real with themselves.
Right.
Might have just tried to stick it out. At least you were like, you know what, I've got here. Let me readjust. I don't really like the way this is. And you change. You make changes, right? So how can people kind of figure that out for themselves?
I think it is about getting that experience, right? So I would encourage, I mean, it is my heart's desire that most people just get started with some small amount of money, regardless. So go out with small amounts of money. Try crypto, try dividend investing, REITs, which provide a cash flow, which is a style that I really like, because every time my phone buzzes and it's like, oh, you've got £10 here, £20 here is a dividend. I like that, right? Some people might actually prefer that. So you have a whole school that much prefer income type of investing, dividend investing. So I would say try all of them out, but never forget that ultimately this is not just about making money. It's also about creating a solution for your financial future, which is why the core satellite approach is really important. Maybe the core should be capital that you've put to work to meet very specific needs, as we spoke about in the very beginning of this episode, about being very strategic and intentional with your investing. And then the rest is something you could just test out. And so if you have a lot of volatility, if it goes wrong, then it's okay, because it's not your whole life savings, and you've got all your other needs, whether it's retirement planning, investment planning, estate planning, whatever it is actually already sorted. I think that's the way to look at it. I'm just very cautious sometimes with certain styles of investing, because it can work for so long and then it doesn't work anymore. And the worst thing that can happen to a gambler is for them to win the first round.
That's true.
Damn. And this is why, if you watch my reaction to whenever Chelsea play, especially the last one I reacted to yesterday, or depending when you're watching this, the game against Nottingham Forest, I did say that, yes, all good that, Chelsea won, but in the first half, they were making mistakes. Do you know what I mean? They made a few mistakes, which could have led to Nottingham Forest scoring. It's only, I don't know what you want to call it. You can call it down to good luck, why Nottingham Forest failed to be clinical. But I'm telling you, the mistakes you know what I mean? It's like, I'm not saying that Chelsea are lucky in the way that they win matches, because that's far from the truth. They still end up playing well to a degree. But the point I'm trying to make is it's the same thing. It's like, you can't lock your way into something just because you won one game or won these trophies. Doesn't mean that it's like, you know what I mean? You got to stick to the strategy, the long term. And sometimes the strategy long term, the same tactics that was used, just because it was working then, doesn't mean that tactic can work now. Like, you think Chelsea can play free at the back now? Oh, you're bugging. You know what I mean? Free at the back? Nah, not happening.
And in investing, you can be lucky like that. In crypto too, you can be lucky. It's the truth,
When we talk about investing, regardless of what the asset class is, it could be stock, shares, crypto, property, regardless of what it is. If you didn't really understand what you was doing in the first place and you won and it went well for you, guess what you do? You end up betting bigger stakes. And that becomes more damaging if it doesn't go your way.
Exactly.
So that's why I'm a bit cautious. But that's the way to mitigate that kind of risk is education. Become very knowledgeable about what you're investing in.
And that's the thing. I think you should always educate yourself, because things shift and change. You know, and actually talk about things shift and change, right? So we were talking about this offline. You know, even so, we were talking about the debate episode that I recently is out now by the time we discussed this, right? So people have this perception anyway that active managers don't beat the market. So then our thinking was, okay, so then why do active funds still attract? They attract billions, not millions or 100,000s. They still attract billions. So what is that about?
It's a question I had to ask myself. It's like, especially as someone in the industry, you know, I want to be honest and integral. Why should we have active mutual funds that don't perform better than the S&P 500 or any index, you know, or benchmark? This doesn't make sense. Ultimately, you want the best. And I think So I asked myself that question, and I've really done the research, and I think ultimately it really comes down to all that we've discussed today, which is funds are not just there for performance purposes. A lot of the time they are there to provide a solution, which could be, and I give you a couple examples so it makes a bit more sense. So for example, it could be that they want to cater to certain clients that will not want to invest in, I don't know, like fossil fuel companies. So there are some companies that will not invest in the FTSE 100. If you invest in the FTSE 100 as an index, but there's a lot of tobacco companies and energy companies in there. So a mutual fund may come and create a solution to that, and they'll still benchmark against the FTSE 100. But the solution ultimately is to strip out some of these companies. But it could well be that because they've stretched out some of these companies who have these products that may be even quite addictive and the stock price is actually shooting up, they'll actually underperform the index. And that's why they have very, very specific types of clients, because they can explain that to a client, and a client could be like, okay, I understand, and that's absolutely fine. So that's the part that a lot of us retailers miss. But the mere fact that all these funds still exist and new funds and new solutions keep coming should give us some sort of inclination that they must serve a purpose. And that's the example that I actually gave. And one thing I will also say is it is impossible for everybody to be an index investor. In fact, the only reason why we can invest in index funds or passively is because we have active investors. Someone has to keep the market honest in terms of valuation and price, and in terms of keeping the market as efficient as possible. And so, yeah, that's one of the reasons why active investors will exist. If everybody started moving towards index fund investing at some point, then yes, at some point, active investment will create, or there'll be opportunities created for the active investor to outperform.
Really?
Kind of thing, yeah. Because it's just how the market works. There'll be valuation, there'll be some sort of dislocation with the market price and all that kind of stuff, because everyone's money will just be going to buy NVIDIA.
Yeah, that's a good point. You're right. It would be allocated to the same thing.
Same stocks, and that will create opportunities in the other stocks that may be a lower amount of valuation in the same index maybe, or even outside of the index, for example. So there's that. And also I think it comes back to a lot of what we spoke about in the beginning of the podcast, when we spoke about pension funds and endowment companies and different institutional money that invest for different reasons and mandates and stuff like that. When you are constructing these portfolios, it could be that there is some index funds in there, but also sometimes, remember, these are portfolio managers, right? And portfolio management is a skill, is an art. It's an art and a science. There's a lot that goes into it. And it could well be that we've constructed a portfolio, but we need we need a solution to increase the I don't want to be technical, increase the risk in the portfolio. We need something different. We need something, do you know what I mean? And it could well be that actually, why don't we, this very specific mutual fund that only invests in companies that have high return to capital employed. This is a very unique term. That's what we want. We want that very unique solution, but in our portfolio. Because when we add that to our overall portfolio, we create a solution that makes sense for this specific client.
Okay.
Do you get what I'm saying? It's not just about putting all our capital in this one fund, because that's not going to outperform anyway. But when we add that fund to our portfolio, it creates this smoothie that actually tastes a bit better.
Okay. Interesting.
That makes sense, yeah.
This is, I like this conversation because I think sometimes we're so binary in our thinking and the way we think about things. Oh, passive investors is king. So why people bother active investing? And I think the way you've explained it makes sense, that there are going to be certain criteria for people. And it goes back to what you say, mandates, right? At the back end of it, maybe some of these index funds are not suited to some people's mandates,
especially now. Especially now, because remember, like, you're dealing with serious money here, and you're dealing with, if an endowment requires an income, right, and a specific yield, or someone's already retired and they require a specific yield to live off, they can't invest in the S&P 500 because it yields, I think, like 1.something%, right? Whereas that person needs at least 4 or 5% to live off, right? So that very simple example means you can't just invest in an index fund. Yes, someone might say, well, okay, at least if there's capital appreciation, you can maybe sell some of the capital appreciation and whatever, but that's not guaranteed. right? That's not guaranteed, and it's not guaranteed every year, kind of thing. Whereas income is more predictable. Or bonds are more predictable, right? Like government bonds, gilts that I mentioned earlier are more predictable. It's risk free, right? As they say. So yeah, it's, and this is what I'm really trying to teach retail investors, that yes, I get it. And I'm a retail investor too. And I had the same questions that you do, but it is very important to try and become very well educated. And one of the practices that I tell people to do is, whatever your thoughts are right now, write an essay with the opposite thought. Yeah, and we call that critical analysis, critical thinking, evaluation, because it will help you to understand why something exists, and you're not so binary in your thinking to think it has to be this way. If it just has to be this way, then people like Warren Buffett won't exist, or Ray Dalio, or Peter Lynch, or whoever you know, they won't exist.
Exactly. Yeah, and that's the thing. We're not saying that everybody needs to be Ray Dalio or Warren Buffett or stuff like that. But like you say, if we're going to argue that then those people don't exist, and they do exist. So it goes back to what you're saying. What is your risk tolerance, and how far do you want to go in this? Because there's going to be somebody out there in the world that's going to be the next Warren Buffett and next Ray Dalio. They've probably already there on their way to it. So I think that is quite important. So that mix between active investing and passive investing, it sounds like what you were saying before, the satellite approach would work quite well with mixing. So maybe your core is like your passive, and your active is the satellite. I like that. That's quite good, because it shows that you can combine both. And I think people should consider combining both, because I think everybody's just core. But I think some people just think just core, and I don't want to vanilla.
I hear it, but using myself as an example, I can never just be in index funds personally. Not because I think they're going to be bad. No, I think if you had a conversation, you said, Jax, I'm going to invest for the next 2 decades, 20 years, and I'm only going to invest in the S&P 500. What do you think? And the question I'll ask you is, how often are you going to check your portfolio? If you said to me twice a year, I'll be like, okay, I like that. Cool. 20 years, you're going to check your portfolio twice a year. That's fine. I think you've got a good strategy. I would say that's fine. Index S&P.
Yeah, but then there's going to be some that don't check. So what happens then?
For the next 20 years, I think you do better than most people, right? But if you said to me, oh, Jax, I might check my portfolio maybe 5-6 times a year, or I'm not exactly sure if I'm going to wait for 20 years before I need this money, or
imagine being able to build an app with your name on it just by base 44.
Or anything that's different from what I said earlier, then I would say you need to reconsider. Right, you need to reconsider, because the volatility you experience in an all equity portfolio. Remember, the S&P 500 is only stocks, it's only equities. You've forgotten about bonds, alternatives, and other asset classes that exist, right? So you have to ask yourself: Are you really willing to experience the volatility in this for the next 20 years? If you are, then absolutely go for the index funds. But the reason why Jacques Opoku can't just invest in index funds is I have too much of an interest in financial markets. I have to be involved. So I can't just leave it and set it and forget it. It's impossible. I watch it, and I know myself. I'm conscious enough to know that for me to have a portfolio that I'm going to stick to, I need to be involved. So does that mean I'm not going to invest in index funds? I am. In fact, I prefer multi-asset index funds because they allow you to choose your risk appetite. Adventurous, balanced, cautious, right? Once that's done, then I can have a bit of fun with my own portfolio. And that will keep me in the game. And chances are I'll do better. I'll do better than myself. Not better than anyone else who has an index fund, but I'll do better than if I was just in index funds, because I will get bored. Does that make sense?
Fair enough. Look, this is why we have these conversations, because I think it's good, it's useful to really pick the brains of somebody that's worked on the institution side, and especially, around that thinking, and then see how we can apply it to like what we're doing day to day. So this is I've got this is my final question for you before I ask where can people find you. If you're building a portfolio today, and I know you're saying the 6-figure thing, the volatility and stuff like that. So, but I'm going to ask you anyway. If you're building a portfolio today for the next 20 years, what themes would you make sure was included?
I like that question. And like I was just saying, it's fun to active in the financial markets, which is why I just can't invest in S&P 500. And I think before I even get to my answer, you can invest in like a world index or the S&P 500 and capture a lot of themes, because these index funds are quite self-cleansing. The best companies are going to be in this Premier League, right, of stocks. So that's fine. But for me, if I'm
hey, look, he finally had a football analogy. It couldn't have been just me to eventually have a football analogy. I couldn't have, but finally he's got one.
In a portfolio, I would adopt a core satellite approach. But in terms of my satellite, which is my active investing, there are certain themes that I think are really going to be important for the next few decades. And it's about looking at demographics. I think one of the themes that I see that's obvious, and I think many people see it, is the aging population, right? So, people are having less kids, for example. People are living longer. What does that mean? And how can we invest with this knowledge? It means maybe I should be focusing my portfolio on healthcare. That's one example, right? Because they have money and they're probably going to be spending on healthcare, right? So there's that perspective. Other themes, I think it's obvious that we can't turn a blind eye to artificial intelligence.
It's impossible.
We can't turn a blind eye. So most definitely I'll be looking at the technology sector. I'll be looking at who are the ones who are at the top of this new revolution, who are the ones that are also not just on top in terms of the providers, but also who benefits, what companies benefit from AI, who are the ones who people may not be talking about a lot. So it could be like, I was reading somewhere the other day that there are these companies that help cool down the use of AI or something like that. Whoever creates it, and I don't know. I didn't read much into it, but it's something I'm going to read into. And that's an area that I'll be looking at. Data centers. So if you're talking about like REITs and stuff like that, maybe I might be paying attention to the data center segment of REITs rather than
I've seen
retail.
one actually, a REIT that we'll talk about it offline if I can Google it. There's one I think that's already big in that space.
It probably is one that I know as well that I'm probably already invested. But we can talk about it offline.
These guys, man, they're so ahead of the game. So you're like, how are you already thought about this stuff? Like,
there's always one. There's always a few that are ahead of the game. But no, I've just looked to see what themes are emerging. Another one that I spoke about a bit earlier, I think I touched on it, was the private markets. Private markets is an area that a lot of retail investors will struggle to have access to, but there are ways to get access to private markets. One of the ways is through something called investment companies or investment trusts. Some of them will have like private equity, or they might focus on private equity and stuff like that. So that's another area that I'm actually actively looking at right now. How can I gain further exposure to private equity? How can I gain further exposure to infrastructure? And the reason why I like infrastructure, which is an alternative asset class, is because it produces a lot of inflation-linked income. And I personally believe that inflation will probably be around.
If you want to make a full-time income from home working part-time, you need to know this one concept, because
much longer, and I think it'll be higher than it has previously been. And so those kind of like inflation-linked cash flows will serve a good purpose in my portfolio. And by adding infrastructure to my portfolio, it adds a nice level of diversification to my portfolio, because it has a different risk to return profile to equities and stuff like that. So yeah, I'll be looking at lots of this stuff, biomedical science. There's a lot of stuff to research, which is why it goes back to what I was saying. I have too much of an interest in financial markets for me to just be in an index fund. But I'm still humble enough to understand that I am not going to outperform the market as a retail investor. So I'm going to make sure a big proportion of my portfolio is just capturing the market.
Your core, and then you've got a satellite, which is a fun. That's good. It's good. And I think this is the way, like you say, it's a smart way to blend it and still build your wealth. And it's like you say, you have an interest in the markets, but you're doing it in a way where it's not having an impact on, how you're building wealth in the majority of what you've got. No, thank you so much, Jackson. It was great having this second conversation with you. I learned a lot, to be fair. I'm not gonna lie, I learned a lot from this conversation, and I know that the audience learned a lot. So thanks so much for sharing, like, you know, your experience in the industry. I think it's so valuable for us, especially as, you know, in the UK, we're trying to get more people to talk about investing, actual investing. I think it really does, you know, give that insight into how, you know, the institutions really think, because I think there is a bit of a misconception with how that is sometimes and how they operate. So I think you really just you know, really shone a light on that. Where can people find you if they want to reach out to you?
Yeah, so as I said, I do a lot of one-to-one coaching and group coaching, and I do speaking engagements as well, and that's through my personal brand, which is Jacques Financial, JAX Financial. I'm predominantly on Instagram. I'm on TikTok now. Yeah, I'm on TikTok. Okay. Yeah, I'm on TikTok.
Actually, I think you're doing quite well on TikTok.
I'm not too bad. I'm also on YouTube. So that's Jacques Financial UK, I believe, on YouTube, which I'm going to be focusing a bit more now that I've got a bit of time in my hands. So that's Jacques Financial, my personal brand. You could book a one-on-one with me or whatever. And then probably the one I want to promote a bit more now is even Woke Finance, where we're working with a specific group of young people. So if you have access to, let's say, youth justice or young people that might have challenging behavior, maybe an alternative education, and are between the ages of 11 to 21, these are the young people that also need hand-holding, a bit of love to say, and teach them personal finance, teach them about credit scores and debt management and how to make more money the right way. And that's Woke Finance. We have an audio-only podcast, which I'm trying my best to get my business partner to make it more visual. I think he would agree at some point. But if you search for Woke Finance on all the platforms, you'll find us. We've got over 200 episodes talking about all things finance, all things finance.
That's good. 200. How long have you been doing it for?
Oh, we've been doing it for about 5-6 years.
Wow, 200. That's crazy. That's well done.
It's a lot of episodes.
The 200 milestone is amazing, honestly.
Yeah.
Well done.
But we talk about everything in finance. And Peter, he asked me some very nice questions. He's a good friend of mine. We've known each other for over 20 years.
Wow.
So audio only, but I guarantee there's a lot of good quality content on there.
Yeah, I mean, audio. To be fair, funny enough, I don't know. I listen to most of my podcasts in audio. It's funny.
Same.
Yeah, I listen to most. I listen to podcasts on walks, gym. If I'm cleaning it up around the house, I do watch as well. I do both, to be fair. I enjoy both equally, to be honest with you, actually. So I like having both options. So that's cool. Yeah, make sure people to go and check out Jackson, reach out to him through all of his social channels. Like I said, bro, appreciate you so much. Thank you so much for sharing like all the gems. We'll definitely do a part 3 because, you know, I think the stock market right now is in a very interesting era and a lot is happening, you know, at right now, and I've got a lot of interest in the stock market as well. That's just because that's the way I am inclined as well, and I'm just very looking forward to seeing what AI is doing and everything else like that. Do you have any final words for watchers and listeners?
Yeah, I think just to wrap up what I said earlier, the best investment you can possibly make is the one where you're going to get positive returns. Probably want to add positive returns above inflation, but the one that you can stick with. That's the most important thing. Of course, when we talk about investing, we have to do all the disclaimers. I'm not your financial advisor. And I think you could put a disclaimer on before we even start the conversation. But yeah, I think I would love more and more people to have the conversation. And I think what you're doing is truly amazing. I think we want to keep an open mind to make sure that we learn and we don't close it to say, oh, it's just index funds or it's just stock picking or it's just crypto or whatever. There's a whole world out there of assets and we can definitely learn and become much better investors if we're proactive and intentional about it.
Thank you so much. I really appreciate you featuring on the podcast. Thanks so much for tuning into this episode. See you next week's episode. If you enjoyed this episode, share your favorite part in the comments, tap the like button and subscribe to the channel. Your support is really appreciated. We'll keep working hard to bring you more valuable conversations.
All right.
Pick up the 40.
You know what your thoughts are in the comments below. Get me. I know what my thoughts are, but let's read the comments real quick. Obviously, I'm gonna like. All right. So yes, our very own Jacques dropping gems. I'm gonna have to subscribe to their channel. Clearly, thanks for having me again. Hope the viewers enjoyed and gained tons of value. Brilliant guest. He really explained the institutional side of investing so well. You should start your own YouTube channel. No offense, I told your channel was fantastic. I mean, did you pay attention? He said he's got a YouTube channel. Yeah, I mean, look, it's this. All right, great guess. All right. Having a mandate is key. Thanks for sharing. So I'm gonna put one of the valuable lessons learned from this episode is making sure you research and stick to something you know that you have tolerance on, and I didn't know at first what a invest. Wait, you know what? Don't do that. Keep it simple. This was a brilliant episode. You know what I'm saying? But yeah, man. If you're interested in finance, go ahead, hit the subscribe button, turn on the post notification because I've got more content I'm going to react to in regards to finance. So you hit the subscribe button, turn on your post notifications. Even like, so if there was the mention of Warren Buffett, so get me, I can react to a few things like a documentary, an interview, all of them stuff there. So if you hit the subscribe button, turn on the post notifications, whenever I go live or post that content, you'll be able to watch there and then. All right. So yeah, man. By the way, if you want to shout out, this is what I recommend you do. Leave it in the live chat or leave it in the comments, and I'll give you a shout out probably by the next episode. All right. So yeah.